Hey everyone, welcome into another daily editorial here on the KE Report. We're going to focus a lot on the precious metals sector and what the precious metals stocks are doing, as I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, Jordan, let's just recap the last about 7 to 8 weeks for the precious metals sector. You have things like GDX that went right up to resistance in the high 31 region. That was in the tail end of February, and then it just flat out crashed, dropped about 50% down to a low of 16 and change, and then in a matter of just over 4 weeks has rebounded the whole way back to that 31 level. It actually just touched a little above 32 just a couple days ago and then started to reverse lower. What's your recap or takeaway from just these flat out extreme moves that we have seen over the last almost 2 months in the metal sector?
Okay, yeah, I'll try and make this as pithy as I can. Number one, the action has been absolutely nuts over the last 7 or 8 weeks. They're absolutely insane. Never seen anything like it. That's why you got to look at the monthly line charts to get a better handle on the trend. And secondly, the fact that gold and the largest gold stocks, that like the Dow Jones U.S. Gold Mining Index, the fact that they were able to not only rally back to their pre-crisis highs so quickly, but then even make new highs, it's just that it's really an amazing recovery. And I know that 2008 was much different, but during that period, and I know the sell-off leading into it was more severe and more significant, but it took months and months and maybe close to a year for those things to rally back and make a new high. I mean, remember gold, I think it rallied back to its high in February, which was, about 4 months after the initial crash. And then, I don't know, 4 or 5 months after that, it was able to break a new high. I mean, gold basically did that in 1 month. It had a really sharp correction, rallied back to 1700, the former high, and it broke above it and made a new high. Took place in about 1 month, or a little bit longer than 1 month. And same thing with the largest gold stocks, Newmont and Barrick. And that's when big money, big institutional money, generalist money, when they want to get into the sector, they go into gold first, and then they go into the largest gold stocks. And so that's what you're seeing. And a secondary effect of that is GDX was able to, just a couple days after the large gold stocks, GDX was able to rally back to its high. It hasn't broken above it yet. And obviously, GDXJ hasn't been as strong, but, we've seen moves in really a lot of quality junior producers and quality junior explorers. We've seen huge moves, probably from their absolute lows, 100% higher in a month in some cases. So it's just been insane. But the takeaway is that the big recovery that we've seen, it's really bullish how fast it was able to happen and how far it was able to go in a short amount of time. Rallying back to resistance and then surpassing it in some cases.
Yeah, no doubt that the washout was scary for a lot of investors, but this rebound has to be encouraging because of just how quickly it's come back. And also, I want you to address the fact that it might not have significantly happened for GDX or GDXJ, but gold bounced back to a new high, or at least a high in terms of the recent high when gold topped out at just above 1700, went through a big fall. Now gold has, it looks like, established itself in the mid 1750 range. Hasn't been able to break out of 1800, but again, another high for gold. That's a big takeaway, at least for me. What's your assessment of gold's new high?
Well, my assessment is I think that it looks like yesterday we probably started a correction because the GDX ran into the 7-year resistance and gold was approaching 1800, which is really, 1800 in some cases might be stiffer resistance than 1900 because gold peaked. It had 3 different peaks at 1800 after it made the top in August 2011. So I think it's logical that a correction in gold could start from here around 1800. But I mean, this again, it's just been nuts. I never would have, after when gold had the strong move down to 1450, I never would have thought it would be able to rally back to 1700 and then even make a new high and get close to 1800 after that. So, I mean, maybe the supply issues because of COVID-19, that's giving the market a lift that we don't normally see during these types of panics. But aside from that, it's just how it's been able to, almost get back to 1800 already. It's really bullish. But Corey, if you look at the gold price in foreign currencies, which I look at, I mean, I have a basket where what I do is I look at gold multiplied by the U.S. dollar, because that's the same as looking at gold divided by the U.S. dollar basket, which is like 2/3 the euro and the yen and et cetera. And the dollar, like if I'm making that equal to the U.S. dollar gold price, it recently hit about 2,400. So that just tells you where the gold price would be if we got some sustained weakness in the U.S. dollar. And recently, gold just made a new all-time high against the Swiss franc. So it's basically now made a new all-time high against every currency except the dollar. So I mean, the near $1,800 gold price, it seems high here in the U.S., but everywhere else, it's a lot higher than that, relatively speaking.
Yeah, exactly. You compare it to what gold's been doing in terms of other currencies, and you can make the argument that it still has some room to run to get to those all-time highs. Let's talk about this potential correction that the metals might be in. It's a lot of markets that look like they're correcting right now, but any thought on a target as to where gold or something like GDX could reasonably correct to? I know it's hard to say just because of how crazy these markets have been.
Well, I would look at GDX and looking at my moving averages here. If you look at the 50-day and the 200-day, these are around 27. There's also a gap there. It looks like in the mid 26s. So that's an area to keep an eye on. And then also if I can talk about this, I did some work on GDXJ and a junior index I have going back to 2001, looking at corrections after these major lows. After the major lows in juniors in 2001, 2008, and 2016. And I mean, every period's been a little bit different, but it looks so far like we're following the 2008 analog. And, after it bottomed, it had one or two sharp corrections. And then after that, I mean, I think it had in the third or fourth month or so, it had a 20% correction. But other than that, the corrections tended to be 12, 13%, 14% in using the closing prices. So, and by the way, the average upside advance, the average rebound from these major lows in the first 6 months tended to be around 200%. So, I mean, that doesn't mean we're going to rebound 200% in 6 months from the low, but it's important to keep that history in mind because something similar could play out, especially if GDX takes out that multi-year resistance. GDXJ would probably follow. But the more important point here, Corey, is when the market is red hot and it's having this really strong move off of an important low. The corrections, they tend to be very swift. They tend to happen very quickly. So I wouldn't expect a real significant correction in terms of time. What I'm saying is, if there's something that you missed, a stock that you missed and you want to buy it and you suddenly see it down, 10 or 15% in a couple days, you got to pounce on that. You got to take advantage of that because what history shows is that these corrections, I mean, they can happen very quickly. Now, GDXJ, GDX, maybe the correction lasts a month or a couple weeks. I don't know. But individual stocks, maybe they correct by going sideways for a couple weeks, but it's only a 15 or 20% correction in junior. When that gets down, 10, 12%, you have to pounce on that because if you see it down 15% and then you think, I'm worried, I'm going to wait for more weakness. you could see it suddenly have a big up day and then the correction's over and you can't buy that weakness anymore. So long story short, I mean, I don't know what I forget what your question was, Corey. But long story short, when you see like 10-15% weakness, intraday weakness in these individual names, you got to pounce on that.
Okay, I think that's a good summary right there. Buy weakness in stocks that you like. Let's also talk about the relationship of gold stocks actually, to the U.S. equity markets. When we see a sell-off in U.S. markets, we usually do see a bit of a pullback, or we have been seeing a pullback in the safe havens. However, gold stocks have been generally performing better than U.S. markets. Does this tell you something finally that we could be in a scenario where money more so is flowing into metal stocks rather than some of these high-flying stocks?
Well, if you look at the GDX to S&P 500 ratio, a couple of days ago, this closed at, I believe, close to a 3.5-year high. It was a new 52-week high, by the way. The previous peaks were in obviously 2016 and the summer of 2019. But those peaks, when they closed at those peaks, the ratio closed at those peaks, it was about a 2-year high. So it wasn't as much of a high as we just saw a couple of days ago. So a couple of days ago was, it could be the start of a real breakout in gold stocks outperforming the S&P 500. But we'll see if markets are correcting right now. Maybe that breakout doesn't hold, in the short term. But it's still really significant. And it tells me, Corey, I think, judging from where GDX is on the chart, and then also judging from this ratio, that after this correction, that could be when we see a real, significant move in the sector, and we see obviously more generalist money coming into GDX, and then GDX can take out that 7-year resistance. So, this is something I've been saying for GDX to take out that 7-year resistance, for the sector to have that big breakout move. We need to see the gold stocks outperforming the S&P 500. So we're finally seeing the early signs of that. With the action in the last couple of weeks. So it doesn't bother me if the stock market corrects and it pulls GDX down a little bit. That doesn't bother me that much here in the short term. I think the medium intermediate term story is we're starting to see early signs of what could happen.
Okay. So overall, hey, very encouraging for the precious metals, but we still might need some sort of more solid bottom in place for U.S. markets too, or at least a little bit more confidence, which has come back into traders' minds. But that rebound in gold, man, oh man, it was fast, and it has taken it to some recent, at least short-term highs. So all very encouraging, but I think a lot of the junior investors still waiting for that money to broadly trickle down to the juniors. But some of the better juniors have actually bounced and are still heading higher. So the strategy of buying the dips still remains true, but boy, oh boy, I know that last washout was pretty devastating in a short-term sense for some portfolios. Jordan, I appreciate your time. Thanks for sharing some of your updated technicals and what you're watching for these markets. We'll chat again next week. Have a great rest of your week.